OPR stands for Overnight Policy Rate. The OPR provides a minimum interest rate charged among banks for interbank loans and is set by BNM. It is one of the tools used by the central bank to formulate monetary policy to control the country's money supply and influence the direction of the economy. On May 11, the Monetary Policy Committee (MPC) of Bank Negara Malaysia decided to increase the overnight policy rate by 25 basis points to 2%. It is done to cool inflationary pressures as the country continues to recover from the lockdown. From 2011 to 2019, the OPR ranged from 2.75% to 3.25%. But starting in 2020, BNM began to lower the rate amid the COVID-19 outbreak that affected the global economy. Firstly, we need to understand, when the OPR goes up, the automatic monthly installment payment to the bank will go up. Also, the eligibility to make new loans with banks will be tightened, and the repayment amount for the purchase of a new house, car, or personal loan will also go up. Also, it signals to foreign investors that the country's economic situation is improving for the first time since the pandemic. Since the pandemic, BNM has lowered the OPR to a lower level by 5 times, from 3.25% to 1.75% in the last 4 years, meaning more people can make loans in the last 4 years because the interest rates are low. The reduction allows for cheaper loans so that businesses can afford to make payments to maintain their business. It also helps troubled businesses by reducing their loan repayment rates. However, the low OPR also causes inflation to be high because everyone can afford to spend. Many people can afford to buy a car, buy a house, and do luxury shopping. With an insufficient foreign labor market and a global supply chain that is still a problem, the price of goods is skyrocketing. Despite rising prices of goods due to low OPR, people can still afford to pay. The higher the price, the more people can still afford it. That's the root of inflation. We want to fix this. We want to reduce inflation by increasing base lending rate. In addition to curbing inflation, an increase in the OPR will also indirectly strengthen the value of the ringgit. Logically, the prices of basic necessities should not be affected. The OPR does not directly affect the cost of daily goods and services, but there may be an indirect effect. For example, it can affect consumer goods such as televisions, laptops, or telephones if they are purchased using a personal loan or hire purchase agreement. But since interest rate increases are only slight, other cost factors such as wages, raw materials, transportation, and facilities will exert a greater influence on the prices of consumer goods. At the same time, small businesses owner may be trying to shift their personal costs to their customers. For instance, a cafe owner now has to pay more for his business loan. He may intend to raise the price slightly to cover the matter as long as the customer can afford it. Besides, small and middle income groups who are often in debt will have to devote more of their earnings to debt repayment. Aside from the rising cost of living, they need to be more economical in other areas. Those with savings, on the other hand, can cover this with greater interest income. However, given the large number of EPF contributors withdrawing their savings during the COVID-19 outbreak, many may not benefit from the rise. As the OPR rises, loan payments will increase as banks shift higher borrowing costs to consumers through interest rate hikes. Historically, banks will raise about 20 BPS to 30 BPS for a 35 BPS hike in OPR. For example, if the banks decide to pass on this hike to the consumers, the base lending rate will most likely increase by 25 BPS. If a bank had previously set its BLR at 5.50%, this will increase to 5.75%. For example, if your mortgage loan is pegged to the BLR and the OPR hike will lead to a higher mortgage interest rate, which means that you will be paying higher monthly repayments. Based on the figure, 25 BPS hike will result in an additional RM 25,492.40 cents paid in interest over a 30-year loan tenure. Borrowers won't be impacted severely by this immediately, as can be seen in the figure, it will raise their monthly repayments by about RM 71.4 cents. However, over the entire loan period, it comes up to a substantial amount.